Private companies added just 44,000 workers in July, below expectations, ADP reports. The old approach just got more expensive. The practical edge now comes from changing process, timing, and tooling together. We will map trigger, incentive shift, and downstream impact before the close. That is how many workers private companies added in July. For context, economists were expecting 110,000. We're talking about a miss that's nearly 60% below forecast. This isn't a minor shortfall, this is the kind of number that changes how investors, creators, and hiring managers think about the next 6 months. The ADP report just landed, and it's signaling something the headlines haven't caught yet. Private sector job growth has been the backbone of the recovery narrative. When the Fed was hiking rates aggressively, the story was always the same: the labor market is strong, so we can keep tightening. But that story is breaking. And if you're a creator, freelancer, or anyone dependent on discretionary spending, this matters immediately. Let's start with what 44,000 actually means. Over the past 3 months, the average private sector job addition has been around 150,000. This July number is barely a third of that baseline. It's not just a dip, it's a cliff. And it's happening while the Fed is still holding rates at a 23-year high. That's the contradiction nobody wanted to see yet, but here we are. Why does this matter for the creator economy specifically? Because hiring freezes cascade. When private companies slow hiring, they also cut discretionary spending. Marketing budgets get slashed first. Brand partnerships dry up. Mid-tier creators who depend on sponsorship deals and affiliate revenue see revenue collapse within 30 to 60 days of corporate retrenchment. It's not instant, but it's mechanical. A hiring freeze in July translates to fewer brand deals in September. The second angle is leverage and automation. Companies are hiring less even as they grow revenue. How? Because they're replacing workers with software. AI integration, process automation, and outsourcing are doing the job that 66,000 additional workers would have done. That's not a conspiracy, that's what the data shows. Fewer humans are needed to move the same revenue. For creators, this is both opportunity and threat. Opportunity because automation tools are getting cheaper and more accessible. Threat because the labor arbitrage that made creator platforms valuable, the ability to reach and monetize millions of people, now runs up against fewer employers with money to spend. Now, the third layer, and this is the one that changes policy. The Fed's entire justification for holding rates high was labor market strength. If labor market strength was always an illusion, if companies were just squeezing existing workers instead of hiring new ones, then the rate hike campaign becomes harder to defend. Markets are already pricing this in. Treasury yields dropped after the report. That signals traders expect rate cuts sooner than the Fed guided. Lower rates mean cheaper borrowing, which means more startup funding, which means more creator platforms and more content tools getting built. So paradoxically, a weak jobs report might actually open the door for creator infrastructure to accelerate. But here's what you should monitor over the next 5 to 7 days. First, the official employment report from the Labor Department comes out in about a week. If that confirms the weakness, if non-farm payrolls show similar softness, then we're looking at a real trend, not a one-month anomaly. Second, watch what the Fed signals. If Powell or other officials acknowledge the hiring slowdown, expect more dovish language, which could accelerate the pivot to rate cuts. Third, track corporate earnings calls. CFOs will start mentioning hiring freezes and headcount reductions. Those calls are where you get early signals about how broad this slowdown really is. For creators specifically, the play is this. If companies are cutting discretionary spending, the ones with direct-to-consumer revenue and owned audiences win. Brands with loyal customer bases can spend less on influencer partnerships and still move product. But influencers and creators without that direct reach start competing harder for fewer sponsorship dollars. That compression is happening now. The smart move is to build your own audience channels, email, Discord, direct support, before the sponsorship market gets tighter. The window to diversify is usually about 60 days from a hiring freeze announcement to when brand budgets actually get cut. You're roughly in the middle of that window now. The broader implication is this: the recovery narrative is no longer about hiring volumes. It's about leverage and automation. Companies aren't growing headcount, they're optimizing margins. That's good for shareholders in the short term. It's not great for wage growth, consumer spending, or the creator economy. But it does mean that the tools, platforms, and infrastructure that help creators reach audiences and monetize faster just became more valuable, because doing more with less is now the operating standard everywhere. That's the real signal embedded in that 44,000 number. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.